Okay, so this is the last method, the double declining balance method. And again, they're using a copier. They purchased on January 1. They're giving you the cost of the copier, the residual or salvage value, 5-year life, and 100,000 copies. And this time they're asking you to use the double declining balance method. They're still asking for the same exact information. They want to know what the depreciation is for the first year, 2011, and the second year, 2012, what your accumulated depreciation is at the end of 2012, and what your book value is at the end of 2012. And both of these are after the second year. So let me pull up my example. And again, I'm going to be using the same asset as well. We purchased this January 2nd, so we owned it the whole year. $900,000 cost, salvage or residual value of $100,000, estimated useful life of 10 years, and the machine's expected to produce 500,000 units. The first requirement is to calculate depreciation for the first 3 years using the double declining balance method of depreciation. So this method of depreciation is very different than the first two. Remember, straight line was cost minus salvage value divided by useful life, and the units production was cost minus salvage value divided by the number of units expected to produce, and that gives you a depreciation per unit, and then you multiply that times the number of units produced during the year. With the double declining balance method, there are 3 distinct steps to figuring out your depreciation for each year. And so I'm going to go through 3 years worth of calculations because a lot of students have a hard time with this, and it's not hard, it's just very different than the other 2 methods. And so the first step is to figure out what your straight line rate is. So what does that mean? That means what would your rate of depreciation be? 5%, 10%, 20% if you were using the straight line method. And so how do we figure that out? You can figure it out one of 2 ways. You can take 1 and divide it by the number of divide it by the number of years of useful life, or you could take 100% and divide it by the years of useful life. So we're going to just do 1 divided by 10, because 1 divided by the number of years is going to give you 10%, right? It actually comes up to 0.1. So 1 divided by 10 gives you 0.1, and then if you convert it to a percentage, that gives you 10%. So that's how much depreciation we will be taking if we use the straight line method, 10% every year for the next 10 years, right? Then the second step under the double declining balance method is then to double that, right? Double declining balance, you're doubling the rate. So you're just going to take that 10% and you're going to multiply times 2. So my double declining balance rate is 20%. That won't change throughout all of the years. So you could actually go in and plug that in to all 3 years calculations. My double declining balance rate is going to be 20%. So straight line rate, again, is just 1 divided by the number of years of useful life. Convert that to a percentage, and then multiply that times 2 to double it, and that gives you your double declining balance rate. So how do I figure out my depreciation? My depreciation is going to be this formula here. So your beginning book value at the beginning of the year times the double declining balance rate gives you your depreciation under the double declining balance method. If you remember from the prior 2 videos, how do you figure out your book value? It's your cost minus your accumulated depreciation. So year 1, my cost is going to be $900,000, right? That's what it cost me to purchase this machine. And that isn't going to change throughout the life of the asset either. So you can actually go ahead and plug in the $900,000 for all 3 years as well. And again, this is going to be a calculation that you're going to have to do on a separate sheet of paper. There's nowhere in my math to do this calculation. So $900,000 is going to be the cost for all 3 years because that cost doesn't change. But my accumulated depreciation will change every year. Remember, your accumulated depreciation represents the depreciation you've taken thus far on the asset. So every year when you take more depreciation, this number is going to grow. It's going to become larger each year. But at the beginning of year 1, right, January 2nd, 2016, I've just purchased this asset. So we haven't used it at all. Remember, depreciation represents the amount that you've used up of the asset. So if I haven't used the asset at all at the beginning of year 1, then my accumulated depreciation at the beginning of year 1 is always 0. And so now my book value is just taking your cost minus your accumulated depreciation, right? $900,000 subtract out 0 gives you 900,000. So your beginning book value for year 1, when you're doing this calculation for the double declining balance method, should always just equal your cost, because at the beginning of year 1, you've not taken any depreciation. You just bought this thing. So now the depreciation for year 1 can be calculated 900,000 times 20%. And so I'm just going to do that 900,000 times 20%. And if we did it in the calculator, 900,000, and then just 0.2 represents 20%, is $180,000. So if I were recording the journal entry for this first year, again, I would be debiting depreciation expense, and I'm just going to abbreviate there, and crediting accumulated depreciation. I'm going to abbreviate there as well. So it doesn't matter which method you're using, the straight line method, the units production method, or the double declining balance method, you're always going to be debiting depreciation expense and crediting accumulated depreciation. So the difference between the three methods is how you come up with the number, the amount that you are depreciating. And so with the double declining balance method, you can see here that this is a lot larger number than what we came up with for straight line. Remember, straight line uses the exact same machine, and under the straight line method we came up with 80,000. Under the units of production method we only came up with 48,000. Double declining balance method allows you to depreciate more in these first few years, and as the asset gets older and a little less productive, the depreciation drops every year. So year 2, in 2017, the second year of this asset, to calculate the depreciation that you would take, you still is cost minus accumulated depreciation is going to give you your book value times the 20%. So what is my accumulated depreciation at the beginning of year 2? Remember, accumulated depreciation represents how much depreciation you've taken thus far. So the only depreciation I've taken thus far is the 180,000. So I can key that right in. That's going to be my accumulated depreciation at the beginning of year 2. So now my book value is going to be 900,000 minus the 180,000. So we can key that in. So my book value is $720,000 at the beginning of year 2. That's the amount that I think we have left to depreciate of this asset. So now your depreciation for year 2 can be calculated. 720,000 times the 20%. So I'm just going to take the 720,000 times the 20% double declining balance rate that we came up with. And so in year 2, 2017, we'd make this exact same journal entry, debit depreciation, credit accumulated depreciation, but the amount this time is only going to be $144,000. Year 3, if we take it one more year, again, the cost hasn't changed. We still paid $900,000 for this asset. The accumulated depreciation at the beginning of year 3 is going to be how much depreciation you've taken thus far. That's what accumulated depreciation represents. So you can look at how much depreciation you've taken thus far and add these two together. So what's our accumulated depreciation at the beginning of year 3? It's the 180,000 we took in year 1 and the 144,000 that we took in year 2. That's the amount of accumulated depreciation. So my accumulated depreciation thus far is $324,000. And again, all that represents is the amount of depreciation you've taken thus far. When you add these two together, you get $324,000. So now my book value is simply my cost minus my accumulated depreciation. So $900,000 minus the 324 gives me my book value of $576. And then I just multiply that times 20% to figure out my depreciation for year 3. 576,000 times the 20% is going to give me 115,200. So you can see here every year my depreciation is going down. And that's what will happen with the double declining balance method. So if you get to a year and your depreciation goes up, you've done something wrong in your calculations, because this method is exactly what it says. It's going to decline every year, right? The double comes from doubling your straight line rate, and then the decline comes from your depreciation is declining each year. So at the end of year 10, the amount is going to be much smaller. And so for year 4, you'd go through and you do this exact same calculation, right? You still have $900,000 cost. My accumulated depreciation thus far is going to be the amount of depreciation I've taken. So I can just add all three of these together, the 180 plus the 144 plus the 115.2. And that would give me my accumulated depreciation thus far. Right? To get my book value, then I just take my 900,000 minus my accumulated depreciation. And then to get my depreciation, I just take my $460,800 book value times the 20%. So you can see in year 4, that depreciation has gone down again. Okay, so that's that. And now it's asking, what is your accumulated depreciation at the end of 2017? So you can look back up at this table that you created. Year 1 was $180,000 worth of depreciation I took. Year 2 was $144,000. Oops, not up. So my total accumulated depreciation at the end of 2017 is $324,000. Again, accumulated depreciation represents the amount of depreciation you've taken thus far on the asset. So at the end of year 2, at the end of 2017, you've taken $324,000 of depreciation. And then the last thing is calculating your book value. So again, that's your cost minus your accumulated depreciation. We just calculated the accumulated depreciation of $324,000. We know that the cost, what we paid for this machine, was $900,000. So when we key that in and we subtract the two, we get book value of $576,000 at the end of 2017.